Greetings, Rene Jarquin, CIO at Single Point Partners. It's been a tough couple of weeks for the markets. Equity markets are down in October somewhere between 7 and 9%, depending on whether it's large cap index or the small cap index. The non-US indices are down even further, probably around 10% since the start of the fourth quarter on October 1st. A lot of factors play into this. We would be firmly in the camp that believes that this is primarily a headline-driven sell-off, not something that presages a deterioration in the fundamentals of companies' profit-generating potential or of the overall health of the macroeconomy. What were the headlines that triggered this? There's several, but I think at the top of the list would be probably a perception that there's that this trade war with China that the administration has undertaken is likely to last a lot longer, that tariffs across a very broad range of goods are going to be a reality for U.S. companies that source components and supplies out of China. I think that injects a great deal of uncertainty. Valuations were, I would say, a little bit stretched going into this, but not egregiously so. And consequently, we don't feel that this sell-off should be interpreted as a precursor to a recession or a contraction, where companies, start a cycle of laying people off and of deferring major investment projects. We clearly don't see that happening. The data is very clear about that. In fact, the jobs market is very robust. Corporate investment is growing very robustly. Companies are very well capitalized. They're sitting on a lot of cash, similar with the banking system. So definitely this would fall into the category of pullbacks that we would call a garden variety pullback. Something like what we lived through in January of this year. Something like what we lived through in January of 2016 when the price of oil collapsed. There was another episode in 2015, the summer of 2015, that was about a 15% pullback. Most people don't remember those pullbacks. They were very sharp, but they were also very shallow and very quick to turn around. So we didn't see a drop like what we all collectively lived through in 08 and 09 when the markets dropped about 40 to 50%. And so with that in mind, I would just say two things. Number one, the hedges that we put in place to protect client portfolios to the downside, which is core fixed income, core bonds, have been working exactly as we intended them to. Over the course of the last 3 to 4 weeks, the bond components of client portfolios are basically holding steady. They're basically holding very nicely. Even as the equity parts of the portfolio, as I said, are down 7 or 8% this month. So that's a very good thing, and it needs to be highlighted. It needs to be said. The second thing I would leave you with is, the question in everybody's mind. So we're down 7 or 8%, Rene. Are we going to see a 20% drop? Is this going to be a formal bear market? Tough to say. I would tend to lean to think that, given the very positive backdrop of the economy and corporate profits, I would be inclined to think that maybe we'll see another 5 or 6% drop from here. But anything beyond that seems to me unlikely as a scenario. And in fact, I would emphatically say that if we do see an additional pullback of 5 or 6%, we would view that as an interesting buying opportunity and as an opportunity to lean into the market and potentially add on the margin a bit more equity exposure across our client portfolios. So with that said, I hope you enjoy the upcoming holidays, and thank you again for your business.